Understanding Robo-Advisors, a comprehensive guide. Introduction. Robo-advisors, often spelled as robo-advisors, have transformed the investment landscape by providing automated, algorithm-driven financial planning and investment services with minimal human intervention. Utilizing technology and data analytics, these digital platforms cater to a wide array of investors, from beginners to those with modest experience in the stock market. This article delves into what robo-advisors are, their history, strategies, benefits, limitations, and how to choose the right one for your needs. What are robo-advisors? At their core, robo-advisors are digital investment management platforms that typically begin by assessing an individual's financial situation and long-term goals through an online questionnaire. Using the gathered data, these platforms offer tailored investment advice and automatically manage users' portfolios, implementing investment strategies with little to no human oversight. Other designations. Robo-advisors may also be referred to as automated investment advisors, automated investment management, digital advice platforms. Key features of robo-advisors. 1. User-friendly account setup. Most robo-advisors offer a simple and intuitive account opening process, enabling new investors to get started swiftly. 2. Goal planning and portfolio management. They provide robust planning and management tools that help users set financial goals and track their investment progress. 3. Low fees. Many robo-advisors offer competitive pricing structures, typically lower than traditional financial advisors, with charges often under 0.4% of assets under management, AUM. 4. Security and education. Robo-advisors usually incorporate high-security protocols for account protections and provide educational resources to help users understand their investments better. The historical context, birth of robo-advisors. The concept of robo-advisors gained traction after the launch of the first platforms, Betterment and Wealthfront, in 2008. Both aim to simplify and democratize wealth management using technology, making it accessible to more retail investors. For instance, Betterment initially focused on rebalancing target date funds, while Wealthfront emerged to support tech-oriented investors with user-friendly software. Since their inception, robo-advisors have evolved substantially, adopting modern portfolio theory, MPT, to automate investment strategies primarily centered around passive indexing, which is often seen as a more stable and cost-effective investment approach. Explosive growth of the robo-advisory market. The robo-advisory market has experienced remarkable growth, with estimates valuing it at $7.39 billion in 2023 and projected to reach $72 billion by 2032. Factors contributing to this growth include increasing investor awareness, a shift towards digital investment solutions, and a desire for lower-cost investment options. Current leaders. As of December 2023, Vanguard Digital Advisor holds the highest AUM with approximately $289 billion. The mechanisms behind investment management. 1. Portfolio rebalancing. Most robo-advisors utilize modern portfolio theory to maintain balanced and diversified investment portfolios. This is achieved through rebalancing bands, which ensure that asset classes remain within predefined parameters. 2. Tax loss harvesting. Robo-advisors employ tax loss harvesting strategies to minimize capital gains taxes. This involves selling underperforming assets to offset tax obligations while remaining invested using different financial instruments to avoid penalties. Benefits of robo-advisors. 1. Cost-effective. Lower fees make investing accessible for individuals with limited capital. 2. Convenience. Users can access their accounts online, providing more flexibility and control over their investments. 3. Simplified processes. With automated investment management, the need for extensive knowledge in finance is diminished. 4. Efficient portfolio management. Algorithms enable ongoing monitoring and adjusting of investment portfolios in real time. Limitations of robo-advisors. While robo-advisors offer numerous benefits, they also come with certain drawbacks. 1. Lack of personalization. Robo-advisors often provide a one-size-fits-all approach that might not cater to individual needs or preferences. 2. Limited human interaction. Many investors might miss the personalized touch and empathy that human financial advisors may provide during challenging economic times. 3. Neglect of complex financial issues. Services like estate planning and intricate tax strategies often require the expertise of a traditional financial advisor. 4. Investor dependency on defined goals. Robo-advisors generally assume that investors have clearly defined financial objectives. Unforeseen financial issues could complicate portfolio management. Choosing the right robo-advisor. Selecting a robo-advisor requires careful consideration of various factors. 1. Fee structure. Evaluate management fees and any other associated costs. 2. Investment options. Consider the range of services provided, such as socially responsible investing or tax strategies. 3. Account minimums. Identify any minimum balance requirements to start investing. 4. User experience. Look for platforms that offer intuitive interfaces and robust educational resources. Target demographic. Robo-advisors have proven particularly attractive to Millennial and Generation Z investors, who are more inclined to leverage technology for financial management. Their comfort with sharing personal information online plays a significant role in their adoption of these platforms. Regulatory framework and safety concerns. Robo-advisors are subject to the same regulatory framework as traditional financial advisors. They must be registered with the Securities and Exchange Commission, SEC, and adhere to all applicable securities laws. Clients should ensure the safety of their investments by confirming the insurance coverage offered by robo-advisors, e.g., SIPC protection. Conclusion. Robo-advisors represent a revolutionary approach to investment management, broadening access to financial advice and portfolio management for a larger audience. While they have unique advantages such as cost efficiency and convenience, they also come with limitations that potential users should be aware of. As the investment landscape continues to evolve, robo-advisors are likely to play a more significant role in democratizing finance for future generations. Whether you're a novice investor or someone looking for a hassle-free way to manage your investments, understanding the ins and outs of robo-advisors is essential for making informed financial decisions.